If you invest in dividend stocks or ETFs, some people will keep telling you that it really doesn't make any sense, and especially that investing in dividends at a young age makes very little sense. Today, we're going to take a close look at the criticisms against investing in dividend stocks and clarify how sensible or not it really is. So welcome to Northern Finance. My name is Alex Bleck. Yes, let's certainly delve deeply right into the first criticism, which is that dividends always come out of the stock price, and that's why dividends aren't free money. That's true at first. Here we have, for example, the stock of Allianz Insurance, which is very popular as a dividend stock and pays out its dividend once a year, always in May, as you can see here. The ex-dividend date, the date after which you no longer receive the dividend from the previous year, is May 9th. This means you definitely have to buy the stock by the 8th of May at the latest if you want to receive the dividend. And since the stock is traded ex-dividend starting May 9th, meaning without the dividend, the stock price will drop by the amount of the dividend, which is 13.80 euros on that day. However, there was other good news that supported the price slightly. As the share price only fell by 10 euros instead of 13.80 euros, the amount of the dividend, in theory and without other factors, the stock does indeed drop exactly by the amount of the dividend being paid out here. So you could say it's just a matter of shifting money from one pocket to the other, but that's not entirely true because dividends have a significant advantage compared to retaining profits by management, in this case Allianz, since dividends serve as a protection for you against mismanagement. That's less likely with Allianz since they are such a large corporation, but it's still not impossible. As a shareholder, you are an owner of the company, even you only own a small part of it. Still, you are an owner. And if the majority of shareholders decide at the annual meeting to pay out a dividend because it seems better than just hoarding the money, then that's how it goes. And you can use your dividend in several ways, such as investing. Option 1 is to reinvest the dividend back into the company Allianz. This is very popular in the US in what's called a dividend reinvestment plan, or DRIP. With that, you additionally purchase more shares of the same company and increase your position for future years and dividends. Option 2 would be to spend the whole thing on consumption.
Hey fellas, look what I found in my pocket. Look, a year's salary right here. What I call them? Fun coupons.
Or option 3 is to perhaps invest the money elsewhere in another ETF, in another stock, wherever. So the dividend gives you a choice, and that's indeed something very, very wonderful. Similarly, companies can also use stock buybacks to bring money to shareholders in a different way, so to speak. Like, to stick with the Allianz example, here we see their official page for the stock buyback program, which was recently significantly expanded to 1.5 billion euros this year, such as can be seen a bit further down in the table, Allianz has been regularly buying back its own shares in large volumes since 2017, only to then, as they say in crypto slang, burn them. They actually take them out of circulation forever, which has significantly reduced the number of shares over the past few years, and thus increased the stock price, the profit, and the dividend per share as well, which is of course very nice for investors since they receive more payouts. Shares are also bought at supposedly bad prices, as here at the average price in 2019. It was at 205 euros, only to drop to 153 euros a year later, which is 25% lower, and many shares were also bought back at that price. So, this doesn't really save the stock price when a massive event like Corona occurs, but it does indeed provide long-term support for the price, as 69 million shares have been burned since 2017 alone, and every year there are a bit fewer shares in circulation. As you can see here, instead of 417 million shares, there are now only 391 million, which, as shown further down in the table, is of course good for earnings per share and dividends per share. To return to the criticism from the beginning, yes, dividends do disappear from the stock price after they are paid out, but it can often make sense to distribute money, and in combination with stock buybacks, the dividend can also increase every year, which is good because it provides a rising, predictable cash flow that is very, very valuable. This brings us to the next point of criticism, which is that dividend stocks only pay out dividends because there is no more growth, making them worse investments compared to those that still have a lot of growth potential, where you can invest a lot in the company and get a better return. Let's take another look at our example of Allianz stock. If you had bought Allianz in 2013, which is by no means a growth company, not even back then, it cost between 100 to 120 euros per share, as you can see nicely in the chart. You would have had a dividend yield of 4.1% and received 5.30 euros in dividends per share, as shown in this illustration. At first, that's relatively boring, but you have to say it's fundamentally solid. Over the years, your equity investment represented by the dark blue line would have looked very favorable and positive if you had always consistently reinvested those dividends, ultimately reaching an average increase of 10% in dividends, or even as much as 12% per year on your investment overall, which is indeed an excellent return for such a predictable income. So, you could have initially increased your investment from approximately 100 to 298 euros in just over 10 years. Incredible, right? With such a boring investment, you can achieve a really strong return thanks to predictable and rising dividends. And by the way, this video is not sponsored by Allianz. It's just a very wonderful example of a good dividend stock from Germany, and that's why it's quite pleasant to use it here. We can also use our example with US stocks. For this, I've carefully selected the stocks, including reinvested dividends, for 5 carefully chosen stocks over 5 years. That means indeed since August 2019, when many stocks had their peak before Corona. At the very bottom, we have Starbucks in green, which despite paying dividends is only up 6% over 5 years. So almost nothing, and that's only because there was a price jump this week since they got a new CEO who is apparently much more capable than the old one and doesn't stop working at 6 p.m., but that's a different story. Still, this dividend stock has performed very poorly. In yellow, we have McDonald's, which as a dividend stock managed to achieve a 39% return. And above that, with a significant lead, is Amazon in orange, which is up 87%. And Amazon as a growth stock has performed significantly better than the 2 dividend stocks, McDonald's and Starbucks. But that's not a rule, because even though Berkshire Hathaway, shown here in red, doesn't pay a dividend, they invest much more conservatively in companies that do pay dividends and have achieved a 115% return over 5 years, which is in fact remarkably strong and only surpassed by Google and ING in our comparison. Growth stocks can often perform better than dividend stocks, but this is by no means inevitable, as we have seen with the Allianz share. If we now simply include this in our comparison and draw the line here in black, we arrive at a return of 67%, which is only slightly behind Amazon and with significantly less fluctuations and more predictable cash flow. These lower fluctuations in combination with a solid return could also appeal to some investors more than the strong growth prospects at Amazon and Co., which may not necessarily materialize, and in that case, Allianz could well be the better investment here. So it's more a question of your own taste and risk tolerance, but in my personal opinion, growth stocks are not inherently better per se. Not necessarily. To be honest, growth stocks definitely have more potential, that's for sure, when it comes to returns, which is why they're called that, especially in an environment of extremely low interest rates like we've had since the turn of the millennium. Growth stocks have simply delivered better returns because money is cheap and future cash flows don't need to be discounted as heavily, making growth stocks more valuable. But we should be very curious to see if this can continue in the long term, given the rising global debt, because with high interest rates, dividend stocks can perform better than growth stocks since they provide cash flow today rather than in 15 years, when the money will be worth significantly less if interest rates are high. Why do I say that? Here you can see the development of US national debt, which was last as high as it is today during World War II, and it will continue to rise significantly to over 170% in just 30 years. That's really crazy. Let's just move on to the last major criticism. And if you like this video, please take a moment to kindly give me a thumbs up and also subscribe if you really enjoy it. Let's move on to last criticism. Supposedly, in general, you don't need dividend payments. Typically, you can just sell stocks if you need some money, for instance. And yes, that's theoretically true, but practically it's not a good idea mentally for most people, and I don't think it's particularly good for me either. Prices fluctuate. Selling in a crisis can mean low returns. ING, that's the way the stock markets are, especially with growth stocks. Selling during a crisis might mean selling stocks at low prices, reducing returns when markets recover. It's harder than holding shares and getting regular increasing dividends. You can plan with this money, like paying for a vacation with ING. ING dividends provide predictable income for planning, like vacations, with Allianz dividends consistently paid since 1982. Especially when you can plan with that money, like being able to securely pay for the next family vacation or something else, because you know that in May the dividend from Allianz is coming and it will be a certain amount, so you'll get that money. You know about the dividend development, for example, with Allianz since 1982, that consistent dividends are paid as long as the world doesn't completely fall apart. In financial crises, dividends were also paid here in 2009, although they were sometimes reduced. But even during Corona, the dividend has actually remained the same, which is also very interesting to see. So yes, you could sell stocks, but psychologically speaking, it's much more pleasant for many, for example, to receive this predictable cash flow instead of having to sell at bad prices during crises. So let's draw a conclusion. Dividend stocks face criticism but are crucial for long-term expense coverage. Anyone who really wants to focus on maximum growth and the highest returns can theoretically completely forego dividend stocks. And yet, dividends are very important for investors in the long run, as at some point you want to cover at least a part of your own expenses with them. That's the goal for everyone, and for that you need a predictable, ideally steadily increasing income in light of inflation and all that, such as ING, and that is what dividends are ideal for, as they then increase by an average of 10% per year and are therefore expected to beat inflation. And even though stock buybacks aren't, in a technical sense, dividends, growth stocks such as Amazon, Meta, Alphabet, and others also buy back their own shares from the market to essentially burn them, which is, for example, a kind of dividend in a way. So even people who consider dividends to be not very useful and invest in growth stocks still receive a kind of dividend, albeit indirectly through the better share price. I personally think that dividend stocks and ETFs can definitely make sense even at a young age, because you can actually experience how your first investments bear fruit and develop well, not just theoretically in terms of price. Especially when you receive a cash dividend directly into your account or portfolio, and that income continues to grow year after year, allowing you to buy something with it. I personally believe that it really absolutely sparks a lot of motivation within oneself to keep going. At least that was the case for me. Personally, I don't invest in dividend ETFs, but rather in my world ETF strategy, while also investing in distributing ETFs with dividends. This way, I combine both worlds in the best way for myself, so to speak. If you're interested in my strategy, then continue with this video here or check out this one about my P2P lending strategy and my top 10 platforms that I have. Also, an exciting alternative to dividends, and let me know your thoughts on dividend investments in the comments below. I'm looking forward to the exchange. Have a good return and see you next time.